students, welcome to my YouTube channel Vision Class. Today we are seeing about NTA UGC NET Paper 2 Commerce. Unit 2 Accounting and Auditing Part 2. I hope all of you understand the previous part of this topic, Basic Accounting, right? If anyone not seen, then watch my previous video of this topic. It is useful. Please like, share, subscribe and give your comments in comment box. Fine. Today's topic is accounting principles. So let's see. Accounting principles is that line created by law which you must not be crossed when you are preparing financial statements or book of accounts. Right? It means accounting principles are the rules and guidelines that companies must follow when reporting financial data. The Statement of Financial Accounting concept is issued by the Financial Accounting Standards Board, that is FASB, and covers financial reporting concepts. Right? In order to make the financial statement more meaningful, acceptable, comparable, consistent, reliable, it is necessary that a uniform system of accounting based on generally accepted accounting principles, that is GAAP, is followed. Generally accepted accounting principles, that is GAAP, may be defined as those rules of action or conduct which are derived from experience and practice, and when they prove useful, they become accepted as a principle of accounting. Right? American Institute of Certified Public Accountant has defined the principles a general law or rule adopted or professed as a guide to action, a settled ground, or the basis of conduct or practice. Fine. Essential feature of accounting principles are man-made, objectivity, relevance, and feasibility. Fine. Mainly accounting principles divided into three parts. These are accounting assumptions, accounting concepts, accounting constraints. Right? So let's see in details. Accounting assumptions include money unit, economic entity, going concern, time period. Right? Accounting assumptions. Money measurement assumptions. Transactions which can be expressed in terms of money are recorded in the books of accounts. The records of transaction are not to be kept in the physical unit but in monetary unit. So, it is also called as a monetary concept. It means the money measurement concept states that a business should only record an accounting transaction if it can be expressed in terms of money. Examples of items that cannot be recorded as accounting transaction because they cannot be expressed in terms of money include employee skill, employee working condition, like that. Right? It, it is useless when we say that we have 20 tables and 10 chairs, right? But rather than these, we say we have furniture worth rupees 90,000, then it makes sense. Only those transactions which can be expressed in monetary terms, then they will be recorded in book of account. Right? This is a money measurement assumptions. Second is business entity assumptions. For the purpose of accounting, the business and owner treated as separate entities. In every business, only transactions related to business are recorded and personal transactions are not taken into account. The business entity concept, also known as separate entity and economic entity concepts. state that the transaction related to business must be recorded separately from those of its owners and any other business. In other words, while recording transaction in a business, we take into account only those events that affect that particular business. For example, if the owner withdraw money for his personal expense, it will be treated as a drawing. And if he brings money or anything in the business, that is treated as a capital, is the liability for a business, right? Third one is a going concern assumptions. Concept is a fundamental principle of accounting. It assumes that during and beyond the next fiscal period, a company will complete its current plan, use its existing asset, and continue to meet its financial obligations. It means it is assumed that business will continue for a long time and will not close in near future. Right? Fixed assets are recorded at the original cost and depreciation is provided without taking into the consideration the current market value of the asset, because fixed assets are a purchase for running the business, not for a sale. Right? This is going concern assumptions. Next is time period assumptions. The time period assumptions, also known as periodicity assumptions and accounting time period concept, state that the life of a business can be divided into equal time periods. These time periods are known as accounting periods, for which companies prepare their financial statements to be used by various internal and external parties. It means economic life of the business is to be divided into periodic intervals known as accounting periods or time period, right? To study the results shown by the business after a time period, it may be calendar year or financial year, right? Second part of accounting principles is accounting concepts. And accounting concepts include revenue recognition, matching principles, full disclosure, and historical cost. Accounting concepts are a set of general conventions that can be used as guidelines when dealing with accounting situation. Right? In that, number one is a revenue recognition or realization concept. According to this concept, the revenue should be considered only when it is realized. The revenue in the business is deemed to have been realized when the property in the goods passes to the buyer. While sales are affected and the buyer becomes legally liable to pay to the seller. Right? This is called revenue recognition or realization concept. Right? Next concept is matching concept. This concept is based on accounting period concept, which requires that there should be a periodic matching or cost incurred revenue and revenue earned during the accounting period. The purpose is to ascertain profit periodically. This concept fixes the time frame for which the performance is to be measured. It may be calendar year starting from 1st Jan to 31st December, or it may be financial year from 1st April to 31st March. Next part of accounting concept is full disclosure. The full disclosure principle states that all relevant and necessary information for the understanding of a company, financial statements must be included in public company filings. For example, financial analysts who read financial statements need to know what inventory valuation, right? This is full disclosure concept. Next part of accounting concept is historical cost. The historical cost concept, also known as cost principle of accounting, state that the asset and liability of a business should be presented in accounting. This concept indicates that the value of transaction is recorded at the price paid to acquire it. That is, at its cost, and the cost is the basis for all subsequent accounting. The value may change in future, but the recorded cost does not change. This concept is based on idea that the asset or resources of the business are recorded in the books at the price paid to acquire them, that is at the cost price. This cost becomes the basis for the accounting of the asset during the subsequent periods. This concept has a limitation that book's value of the asset as recorded may not reflect the true worth of these assets. Right? For example, a company like ABC Limited has purchased the asset worth rupees 10,000. It will be recorded at that cost. Next year, it will be shown cost depreciation, not on the basis of market price. Right? This is the historical cost concept. Next part of accounting principles is accounting constraints. Accounting constraints, these are materiality, conservatism, consistency, cost benefit, and objectivity. In the field of accounting, when reporting the financial statements of a company, accounting constraints are boundaries, limitation, or guidelines. It is also known as the constraint of accounting. These constraints may allow variations to the accounting standards an accountant is trying to follow. Right? Accounting constraints may allow for variation to the accounting standards an accountant is trying to follow. There are five types of constraint. These are: number one is a materiality constraint. The term materiality refers to an accounting constraint that is used to determine the relative importance or value of an item to one of the company's financial. The materiality constraint is a threshold used to determine whether business transactions are important to the financial results of a business. If a transaction is material enough to exceed the constraint threshold, then it is recorded in the financial records and therefore appears in the financial statement also. This is the materiality constraints. Next is conservatism constraint. The financial accounting term conservatism constraint refers to an accounting constraint that states when the doubt report information that does not overstate income or assets or does not understand expense or liabilities. Conservatism principles is the accounting principles that concern about the reliability of financial statements of an entity, right? It recognizes expenses and liability as soon as possible when there is uncertainty about the outcome, but to only recognize revenues and assets when they are assured of being received. The conservatism principles can also be applied to recognize estimates, right? Next constraint is consistency constraints. In accounting, consistency requires that a company financial statement follow the same accounting principles, methods, practice, and procedures from one accounting period to the next. right? This allows the readers of the financial statements to make meaningful comparison between years. This constraint emphasizes the use of uniform accounting practice from one period to another. It means that same accounting methods will be used for similar times over a period of time only when the accounting practice are, right? Next constraint is cost constraint. The term cost benefit constraint refers to an accounting constraint that states the cost of providing information must be measured against the benefit derived from the use of that same information. The difficulty in cost benefit analysis is that the cost and especially the benefits are not always evident or measurable, right? The costs are of several kinds: cost of collecting and processing, of disseminating or auditing, of potential litigation, of a disclosure to competitors, and analysis and interpretations. Right? Benefits to prepare may include greater management control and access to capital at a lower cost. Users may receive better information for the allocation of resources, tax assessment, and rate regulation too. Right? Next constraint is objectivity constraint. Each recorded transaction in the book of account has sufficient evidence to support it. The transactions are to be recorded on the basis of vouchers, receipts, and memo, etc. Right? The the objectivity principles is the concept that the financial statements of an organization be based on solid evidence. The intent behind these principles is to keep the management and the accounting department of an entity from producing financial statements that are slanted by their opinions and basis. Right? These are the accounting principles. Fine. According to the school, through principles means fundamental belief or general truth. Right. The basic features of accounting principles are usefulness, objectivity, and feasibility. Usefulness means an accounting principle should be useful, that is, an accounting rule which does not increase the utility of the records is not accepted as an accounting principle, right? And second one is objectivity. Accounting principles should be objective in nature. It should not be influenced by the personal basis. Third one is feasibility. It means accounting principles should be practicable and feasible, right? I hope all of you understand the accounting principles very well. If it is useful, please like, share, subscribe and give your comments in comment box. Thank you.